Welcome to Joe's Happy Hour, a show about markets and life hosted by Joe Fahmy. This podcast is for informational and entertainment purposes only and should not be regarded as personalized investment advice or relied upon for any investment decisions. Joe Fahmy is an employee of Zor Capital, and he and his clients may maintain positions in the securities discussed in this podcast. All opinions expressed by Joe are solely his own and do not reflect the opinions of Zor Capital. The views expressed by guests are their own, and their appearance on this program does not imply an endorsement of them or any entity they represent. Thank you and enjoy the show.
Brian Lund, welcome.
Joe Fahmy, thanks for having me here. What took so long?
So cool to have you here.
Hey, do people know there's not really alcohol here?
I know, it's a happy hour. People think it's an actual bar behind it.
I know, right?
It is pretty funny.
Give me an IPA.
Brian Lund, trader, writer, drummer, creator of the Lund Loop, which people can find at thelundloop.com. You're the secret weapon on my Twitter Spaces, which I've called you that.
Yep.
And your pinned tweet says, fun fact, I'm more palatable in person, which I would say, I actually like you on social media, but I think you're great in person. But thanks for being here. I appreciate it. We've known each other for a long time.
Yeah.
And give the audience a little bit of an intro from the stuff that I might have left out.
Yeah, so, I mean, I've been trading for a long time, since 1985. I'm also a writer. I like writing about the markets, writing about the psychology of markets. I'm a drummer. You know, I'm just, I'm an all-around great guy.
Okay.
Yeah.
You're a phenomenal writer, by the way.
Oh, well.
When I first got to know you or heard of you, I was captivated. So your writing's phenomenal. So
I appreciate that.
It's a gift. I mean, not everyone writes well. How did you get interested? I know it's, the generic. How'd you get into the markets? How'd you get into trading? But people want to know the story, so I'd love to hear about that.
Yeah. So way back in the day, they used to have these things called newspapers. They would actually deliver them to your house.
Hold on. What is
write that down. N-E-W. And I was fascinated by the financial section of the newspaper. Like, I would open it up, and I didn't know what the numbers meant, but I was just like, I felt like there was a puzzle in there that if you could solve it, you could make some money. But the idea of being involved in the markets in any way, like in the 70s and the 80s, especially on the West Coast, when you don't have that whole Wall Street ecosystem, like a lot of these East Coast guys have, I was like, there's no way that's going to happen. Then my great aunt, who had never had kids, told me that she was going to leave me this little stock portfolio she had when she passed away. It wasn't a whole lot of money. I mean, I guess it was for then. It was maybe 25, 30 grand. And of course, I immediately started looking into everything about stocks, right? PE ratios and fundamentals and whatever, value.
How many stocks do you remember roughly were in that portfolio?
I'm going to say there were like 10 to 12, and they were like super old school. It was like there was a GTE, which was like before Pac Bell.
Yeah.
I think IBM was in there. It was all like very blue,
old school blue chips.
Nuveen mutual funds.
Yeah.
So anyway, unfortunately, my dad came down. He was diagnosed with a cancerous tumor, brain tumor, and so at some point she decided, probably better if I leave the stock portfolio to my parents instead of 16-year-old kid. So I kind of missed that ability to get involved there. And I had to wait until I turned 18 to actually open up an account. Back then you had to wait till you're 18. Nowadays, apparently you can get on Robinhood when you're 9.
When you're, I think, in preschool, I think they allow. Yeah. And then you remember your first trade?
Yeah. So back then there was no online trading, obviously. And you didn't have brokerages on every corner. So I did what every 18-year-old would do in 1985 if they wanted to trade a stock. I went to the mall, right? Because at the mall, they had a Sears.
Okay.
And back then, Sears had what they called a financial suite. So they had like Genco annuities, they had Allstate insurance, and they had Dean Witter brokerages. So I drove to...
That was part of Sears?
Yeah.
I don't remember that.
Yeah.
I remember, I know Morgan Stanley bought Dean Witter, but I didn't know it was part of Sears. Anyways,
so this
people don't even know what Sears is. It's like Kmart and
exactly
all those old school department stores for people under the age of 100. Go ahead.
So I drove over to Westminster Mall in Orange County, went to Sears, and sandwiched in between the Craftsman tools and the Kenmore washers was a Dean Witter. And I walked into Dean Witter, and the broker on duty, right? I said, I'd like to buy. His name was Randall Woodworth. Swear to God, that was his name, right?
Okay.
Perfect 80s broker name. Goes by Randy these days. Back then he was Randall. And I said, I'd like to buy $300 worth of Altos computers. Didn't really know what Altos computers did. Figured it maybe had to do with computers because that was in their name.
Yeah.
And he said, call me back in 7 hours and I'll tell you what price you got filled at. So that was my first trade. I think it was a push. I made a little bit, maybe lost a little bit. Second trade was in a stock called Arrow, and their big claim to fame was they were going to make caffeinated gum. I think that was a push as well.
Caffeinated gum. Okay.
Yeah. But on my third trade, I had the worst thing ever happened to me, worst thing that ever happened to a new trader. So all my friends were moving out. You know, we're like 18, 19, moving out of their parents' house. And one of my buddies moved down to Newport and was renting a house with 3 or 4 guys. One of the guys that lived with was older guys, really old, like 23, 24, right? And one day I'm talking to him, and he says, my company has this great desktop publishing software. And in about 30 days, IBM's going to announce that every PC they ship is going to have a copy of this. And I think you should buy all the stock you can. I said, great. So I gathered all the money I had in the world, which is $800, bought all the stock I could. 30 days come, and they announce this, just like he said. 30 more days come, Hewlett-Packard does the same thing. And then 30 more days, Dell does the same thing. And so in 90 days, I turned $800 into $8,000. I like 10x'd it.
Oh, wow.
So
just common stock.
Well, yeah, but the stock was Adobe Systems, right?
Okay.
And so I immediately told everybody, this is what I'm going to do for the rest of my life. I will be a multimillionaire by the time I'm 20, 21, at which point I will retire to a tropical island with 6 to 12 supermodels.
6 to 12, one for each day of the week?
Right.
Okay.
And as everybody knows, that's exactly what happened.
Just to rewind, you're born and raised in
Huntington Beach,
Orange County, Huntington Beach. Okay, so you've been there. You've seen that. That's a whole other podcast. You've seen that change and develop.
Yeah, from a very sleepy surf town to the center of finance when Future Proof is in town.
Yeah, that's right.
But when I say the worst thing that could ever happen to a new trader is like it seemed like it was so easy, right? I didn't do anything. I made more money than I had ever made my whole life. And I just thought, well, that's all you got to do, right? And then I spent the next 10 to 15 years, swinging between making money and almost blowing my account out, and making money and almost blowing my account out. So it was a rough entry into the world of trading.
What did that do for your mindset, or were you not really thinking? Because I know we talk a lot about, not just on Spaces, but in general about how psychology is such a huge portion of trading.
Yeah.
Was that even a factor back then? Were you even thinking about mindset? Was it even like, I'm just a young kid and this is great, like being in the markets? Or?
No, what I was doing back then is, the best thing I can say is I was chasing success, right? I would try a certain methodology, work for a little while, and then it wouldn't work. I'd try something else, it would work, it wouldn't work. I would do that with different asset classes, different styles of trading. After about 15 years, I look back and I hadn't really accomplished much, and I tried all these different things, and I was like, what's the common denominator here over the last 15 years? And I was like, oh, it's me, right? And I realized I was the problem. And that's when I first started to think about how to get me out of the process of trading, meaning like, that part of us that's subjective, that's reactive, that's emotional. And so ever since then, that's kind of been my goal, is to figure out how I can minimize my own influence on my trading and my methodologies. And it's something you have to do on an ongoing basis. It's not like you just do it once and hey, so I'm always trying to bring myself back to center on that topic.
Okay. Any trade that humbled you the most that you can think of?
Yeah.
Or 2 or 3 or something like that.
Yeah, no, I've got.
And what did that experience teach you?
Well, the first trade, I have 2. The first one, so I'm on the West Coast, so market opens at 6:30. And in the 40 years I've been doing this, I can count on one hand the times I've been asleep when the market opened at 6:30.
Okay.
Once was, ironically, 9/11. But I had a position in Oakley stock. And
the sunglasses company? Okay.
Yeah, and it's pretty big for my age at that time. And I kept thinking to myself, well, I should put a stop loss in. And I was like, nah, I don't need one. And so I slept in one day, and I woke up to the news that Sunglass Hut decided that they were no longer going to carry Oakley, or they were having problems, so they had to send a lot of inventory back.
Okay.
And Oakley literally dropped 50%, right? And I remember thinking oh, it will come back. And I think I averaged into it over a year, and it never did come back. And I lost like 75% of my account size. And so I remember thinking, like, always know where you're going to be out of a stock and always have a stop in, and don't sleep through the open, right? But I think a trade that taught me more about the markets was during the financial crisis. So if you remember the financial crisis, everything was crazy. I mean, it was like we were in uncharted territory.
Yeah.
And it was a Thursday, and over in Europe, they had announced that they were banning short selling of certain financial stocks. Right?
I do remember that. Yeah.
And so I thought to myself, what happens if they do that here? Wouldn't that be amazing for the financial stocks? And so I had been trading a stock called Intercontinental Exchange, ICE, at that time.
Yeah.
And it was trading like 123.50, and I thought, why don't I just buy some 125 calls on the outside chance that overnight we do the same thing that they did in the UK. Sure enough, that's what happened. So I wake up the next morning, ICE is trading pre-market at like 140, right? So I'm like,
wow.
Right, and everything was up. There were like 100 names that they said you can't short, financial names, right? And they all spiked. And so I'm like, I'm just counting, what color Lambo do I get? Yeah. So the market opens, and my calls are going at 1350 by 1375. So they're not even reflecting the intrinsic value, right? They should have been like 15 at least.
15, yeah, at least.
And I'm like, that's weird. ICE goes up to 145, and the calls are not budging. And then they go up to 150. And I'm thinking, I should have $25 at least here, and it's showing 13. And part of me is like, go ahead and hit that bid, take it. And other part of me is like, no, you're owed. You're owed.
That's what you're in the money,
right? $12 more. Goes up to 160, and it's still not moving. And something in my head said, hit that bid. So I closed it out at 1350.
And that's what you got. So it wasn't like a bad quote or something like that.
No, what happened was, after everything had died down that day, it turned out that because the options market makers couldn't lay off their risk by shorting stocks, they just backed away from the market. And they weren't making any more markets past that price. That was the highest that option trade ever went for that day. And that taught me a lesson that when the mechanics of the market are breaking, right? When the market is doing things that you don't think it should do, or you don't sit around to find out what's going on. You just get flat, or you at least look from a risk profile, like where could I be hurt here?
That's a fascinating story, because I don't want to say you're entitled to, or like you said, owed, but you're $25 in the money, and they're pricing you $13, $14. Like, you have no recourse. I mean, I trade options, but I don't even know how that works.
I imagine if the options had closed that day in the money at those levels, you would have been you could have either exercised the underlying stuff. You could have.
Yeah, I was going to say, can't you exercise?
But it came back down below that price by the end of the day. So it spiked up like this, and by the time the stock closed out, it was like 118. So it never got there. So I've seen things like this where you have like the oil futures, right? And they go negative, and people think like, well, that could never happen, right? So when that happened, I go, yeah, well, I've seen things crazier than that. So that was just that was something that taught me that we look at the market as this very it's all together. It works a certain way. Nothing goes wrong with it, but things actually break. I mean. And when they do break, it always goes bad. I mean, you can look at XIV, where people got blown up a few years ago.
Flash crash.
Yeah, so that was a lesson to say to me, always look at where you could get hurt, and don't think you're smarter than the markets. And if you don't understand what's going on, just get out, or just get flat.
Yeah. For the audience at home, how would you describe your style? Because I know there's a lot of different styles. Is it more trader versus investor, more growth versus value, technical? Like, how would you sum up sort of your pitch on your style?
So when I was a younger man, because I'm still young, goddammit, but when I was a younger man, I was all about like what's happening in the next 5 minutes or the next 2 hours, or day trading, very fast stuff like that.
Yeah.
That's a young man's game. And as I've gotten older, for me, the sweet spot is if you can swing trade, that's the best scenario in terms of how much effort you have to put into the market and what return you can get. But as I've gotten older and as my priorities have changed and as I don't have as much time to look at the market on a tick-by-tick basis, I'm trying to marry somewhat fundamentals with technicals. So like looking at companies that have a good fundamental story, but making sure they true up with the technicals. And then if those two diverge, making sure that I'm always going with the technicals, because the times that I've said, oh, well, I'll ignore the technicals and I'll just stick with the story, that's when I've got hurt the most.
Yeah, you mentioned, so when you say swing trading, I think even that has a range. When someone says, like, when someone tells me they're a swing trader, I don't even know what that time frame is.
Right.
Like, would you agree it could be a few days, a few weeks, a few months?
Yeah. I generally define it as 3 days to 3 weeks.
Okay.
But if you have a stock that you have for 3 weeks and there's no reason to sell it, you hold on to it, right? Or if you have a stock that you've had for 2 days and then it goes south on you, you sell it, right? So there's a lot of terms. You know there's a lot of terms in trading and finance that are just ambiguous, but that's how I define swing trading.
Okay. Yeah, you did say, and I do agree, it takes a lot of emotional, mental capacity, shorter term trading, all that stuff. So you alluded to, you know, as I don't know, have you matured yet, or maybe?
It's on my schedule. I haven't got to it yet.
Is it in your calendar?
My wife really wants it to happen, but
okay. But as you've matured as a trader, hopefully, and all that, different priorities. So that leads me to, how do you view money? Like, do you view money differently now than you did 20 or 30 years ago?
Yeah, totally. I mean, I would say I was divorced from money. I just never, I don't know, I wasn't raised in a house where money was a central, character, I guess. So I didn't really, I thought about money in more of an abstract sense, right? And I guess I always thought about risk in a little bit of an abstract sense, but reality has this way of changing how you think. And, you get older and you see people starting to move ahead and you go, oh, maybe I should get my shit together, right? And then you have a wife and then you have kids. So I've totally come from, that very risk on, I'll just take a shot. I wouldn't say degen, but a little bit of that when I was younger.
Yeah.
To more, not conservative, but, look, I tell everybody, before you put $1 of risk capital in, before you trade one stock, you have to have all your foundations in place, right? You have to have your retirement accounts. Like 95% of people should just be indexing, dollar cost averaging, ETFs, right? I do all that stuff, right?
Okay.
I've got the 529Bs for my kids when they were born. Having that foundation, it makes it a little bit easier to take risk in other areas. So that's the evolution. Before, it would be like I take all my capital and it's all going to be risk capital, right? Now it's broken up into longer term, like I said, the 529B accounts, and then I have very segmented risk capital that I don't commingle the two.
Okay, so you have some longer, some for more of the swing trading and so forth.
Yeah, and I have some that I don't even it's an RIA takes care of it, and it's a target fund date portfolio type thing. Like I don't even want to know about it, right?
Yeah.
So, I see my hand coming here. Like
that's okay. No, it's fun.
Yeah, it is fun.
I'm checking out my Hawaiian shirt. You know the expression, the fatter the man, the more Hawaiian the shirt.
Is that what they say?
Yeah, that's what they say.
Good to know.
So that's why I'm wearing my Hawaiian shirt.
I wore my shirt in
what's your shirt?
Homage to our friend JC. This is his,
I didn't see the one. The mic was blocking the one.
The Fibonacci. This is his
Chateau Fibonacci.
This is his wine that he makes.
Oh, okay. That's shout out to JC, who's a great friend of ours. Yeah, the reason I mention, your view on money and so forth is I have a pet peeve when I love 3-day weekends in the markets. I absolutely love it. I think trading is intense. It's emotionally, mentally draining.
Yep.
I'm not always watching the screen, but I love tape reading, and it's just like anything. It can just be a lot, and I love 3-day weekends.
Yeah.
And it's like some people, and whether people agree with me or not, it's not the point. Some people say, yeah, I get it. And some people say, absolutely not. I want 24/7 trading. Screw you. You hate the markets. You don't like making money, blah, blah, blah. Turn those machines back on a Monday. We just had, President's Day, and we have all the Labor Days and all those things that are when we have Mondays off. What are your thoughts on that?
I would argue that most of those people are younger people, though, I think, right? I don't think people our age want to be looking at the market 24/7, right?
I don't know. That's a good question. I haven't thought about that.
And I think one of the problems is just because you can do something doesn't mean you should. Like, so we have the technology to do 24/7 trading. I mean, we're basically at 524.
24 or 5 in some brokerages, yes.
But I can't see how it's not going to go 24/7 because the brokerages, I mean, all these institutions make money off of volume, right? And so you're skipping 2 whole days. But like, what happens when a Russian pipeline blows up at 3 a.m. on a Saturday? If you are a client, especially of like an RIA...
Well, Russia's fucked at 3 in the morning.
They're totally fucked. I break out the vodka. Sorry, Russian.
Yeah, there's like the 3 people in Russia who are watching you.
Ivan. He's Bulgarian. Sorry.
It's close enough.
So, but what's going to happen if you are an RIA? Like, your clients are going to want to talk to somebody, right? They're going to want to know what's going on right away. They need hand-holding. So it's not just that you have the mechanics that can do this trading and that you have people that will do it. It's what about all the clients whose net worth, P&Ls are based upon the stock market? I mean, how people are already obsessive looking at their P&L, their 401k, 4 or 5 times a day. How's the industry going to support that 24/7? I don't know. It's going to be. I'm sure they'll solve it, but it's going to be interesting.
Well, right now it's only the top liquid names, maybe the S&P, 10 or 50 or something, or the OEX, the S&P 100 that are liquid, and the big ETFs. But if you want to trade some obscure biotech, you can't do that,
right?
On Robinhood or whatever else there is. So, I don't know if there'll be. I don't know if you can make a market in 10,000 stocks 24/7.
Yeah,
you can in Apple and SPY, but can you in, again, like a small cap semi or biotech? I don't think you can.
But I would argue that most people, the average person's, especially if it's a managed portfolio, is going to have your Apples, going to have your Nvidias, going to have those,
larger cap,
right?
mega cap.
And even if they don't, they're going to see what happened to Apple overnight, and they're going to know, well, I've got tech stocks too. So I don't think it's such a clean. I don't think the idea is fully thought out, and I think there's, a lot of unintended consequences. I think is going to factor into this quite a bit.
Yeah, that's a good point.
It'd be fun to watch.
Yeah.
I'm glad I'm not young. Let's put it that way. I'm glad I'm, maybe 2/3 of the way into my career, because I wouldn't want to be, like, I don't know how these crypto kids do it. Like, this is where I talk to camera and pretend I'm an old man. Like, I literally don't know how they do it. My sister lives here. You know my sister, right?
Yeah.
So she lives here, and I'm staying with her, and she's got a son who's like 17. He's into crypto. Right?
Yeah.
He's up at 3 a.m. trading whatever coin, right?
Yeah.
Like, I don't want to do that.
Yeah. I mean, it's I've seen some poker players, young poker players, and they open up their whatever app they have, and most people will have 10 blue chip names. They have 10 different coins.
Yeah.
And that's what they love. And it's meme coins and whatever. And I don't judge. I don't care. It is a younger person's game for sure.
Yeah, and I can't, I've been skeptical of crypto from the beginning, and I get it. Like, it's gone to the moon, but like, I still believe that 99% of all crypto coins are going to zero. Okay. Not Bitcoin, not Ethereum, but there's so many of them.
The fart coin.
Yeah, right. Fart coin or jail coin, or there's
everything. There's everything. Yeah, it's pretty crazy. I love our conversations on psychology. I think you offer a lot of insight. When I talk about you being, like, around COVID, we did a lot of the spaces, and I talk about you being the secret weapon, and not only for 2 reasons, for a lot of reasons, but the 2 main ones that stick out to me is you're very knowledgeable on a lot of different topics, and you also bring a little bit of a calmness or voice of reason when everyone's like, I got to talk, and everyone's screaming, and this is gapping up, and this is down, and you're very chill about things. And I do enjoy our conversations on psychology. So trading can be very isolating. How do you handle that? How do you work on that mental toughness and making sure you're focused in a world that can be very difficult, and as a trader.
Well, this is going to sound a little self-serving, but like 3-4 years ago, so you mentioned the Lund Loop, which is my newsletter, right?
Yeah.
3-4 years ago, I just decided on a lark I was going to create a Discord for my subscribers. Like,
Okay.
I thought like 5 or 10 people would.
Let's rewind. Tell people about the Lund Loop.
Yeah, so the Lund Loop is an outgrowth from. So I started a blog in 2007 called the BC Lund blog.
Yeah.
Worst name in the world, right?
No, that's when I started reading in Phenomenal Writer. That's what I was referring to. Okay.
Thank you. And that blog eventually got picked up by the Stock Twitch blog network, which you were on,
which I was on,
JC and Josh and Howard and all those people.
Yep.
And then at some point I transitioned it to Substack. And in 2018, I think I turned it to paid, right? So there's like a free version of it and there's a paid version of it. And what I basically do is every day, at the end of the day, I do like a daily update. I go through and do my analysis of the market and try to really narrow down what stocks we think have the biggest potential to move in the next 1 to 3 days, right?
Okay.
So that's the 30,000-foot view. So I'm always looking for things that are value add for my subscribers, but I need to balance it out between I can't give my whole self to them, but I want to give as much as I can. And so I thought, well, why don't I start a Discord? My kids had been on Discord. My cousin or my nephew that I just talked about, he's on Discord. And I thought maybe 10 people, 10, 15 people would say yes. I had 400 people that said, yes, I'd like to be in the Discord.
Wow.
So I was like, okay. So we start this Discord. I wasn't really sure where it was going to go, what the purpose was, but it has been the most incredible thing for me as a trader, and I hope for my community, because unlike Twitter, we have 2 rules in the Lund Loop Discord. First rule is no a-holes.
Okay.
You can't be an a-hole. Okay, so
you found 400 people that aren't assholes?
It's crazy, right?
It's impressive.
There's no trolls, no malcontents, no misanthropes, no nihilists. You can be a bear or a bull. You can be technical. You can be fundamental. You can be short, long. I don't care.
Just be a human being.
Just be a human being.
It's
the anti-FinTwit, right?
It's such a huge ask of people.
It is, and so that's the first rule. And the reason we have that rule is because the second rule is we're all there to help everybody do better in the markets. And when I say do better, these are a lot of euphemisms, like I want to be we want to make more money, right?
Yeah.
But I'm not going to speak for my whole community. I'll speak for myself, but I think a lot of them feel this. We're not just making money for money's sake. Like, money has a purpose, right? Money provides you freedom. It provides security for your family. It allows you to support causes and people that you care about. Like, those are real things. So no a-holes allowed. And everybody needs to help everybody in this community. I've had to kick one person out in 3 years, one person, which I think is amazing. So the long answer to your question is, this community has taken away that isolation part of trading for me, right? Because, there's a lot of people that I know on FinTwit like you and JC, and I love you guys, and we hang out. But Twitter is it's a sewer. It's a toxic mess. This is my thing that I can control, right? Where everyone's there for a common purpose, right? And the best thing is that, so I was up I think you're going to interview Shannon, right? Brian Shannon.
Yeah, shortly, yeah.
So I was up hiking with him today. When I'm out, gone, it creates its own content. Like, they're doing stuff, they don't need me there, right? Because there's smarter people in that community than me. So it's been this late in the trading game, I never thought something this consequential would happen in how I view markets and interacting with traders, but it has. And
that's a sign of a leader.
Well,
they say the fish stinks from the head on down sometimes. Well, this is great from the top, It's
kind of you to say that, but if you were in that community, there are just such solid people. I mean, they're just giving and giving and giving their information. What's great is not everybody has the same technique or the same style. So someone might come in with a fundamental take on a company that I would never see, right? And so then I go, and then I can run it through my technical filters, and maybe I find something that I wouldn't have. So it's great.
So I'm sure people are going to want to ask. First question, and sorry if you mentioned this, is this a paid group with the Discord?
Yeah. So
or it's part of the Lund Loop?
It is part of the Lund Loop, but it's part of the paid part. And the reason why is because it sounds crazy, because I don't charge very much for Lund Loop, but I need some friction to filter people out. I just do.
There's nothing wrong with that.
Yeah, and I think it's reasonably priced, but it just makes sure that the same people that aren't on FinTwit aren't getting in there. And
right, because if you're going to be a troll, it's easier to do it for free. So at the lundloop.com, they can find out information.
Yeah.
Not only about the writing and the regular content you put out, but also the Discord is part of it.
Yeah,
as well.
so there's a free version and a
I'm whoring you out if you haven't noticed, but you're my guest. So
Joe Fami. So you can sign up for free, and there's content, and you'll get stuff. And I think some people think that's just enough. And then if you want to be a premium member, you can sign up and get the Discord and whatever. So
okay,
I feel so dirty.
No, I know. Well,
give me a wire brush, please. Where's the producer in here?
It's a sign of humility. I know we're not trying to sell anything, but it's some people, if they're interested, they're going to be like, well, where do I find this?
Sure,
because you got a cool community of people, and I might join just to be the second person you kick out.
There you go.
So that might be my goal. Right. But going back to the psychology, you have found this group to help with the isolation of trading?
I think so, because when you are doing anything in a bubble, you don't know what the baseline is of anything, right? And so when you're talking to people and they're sharing that oh, I'm struggling with this too, or I saw that issue, or whatever, you go, oh, it's not just me, right?
Yeah.
And there's something about that, right? There's something about knowing that you're not because I've done this 40 years and I still struggle and I still make mistakes. I'm sure you do too, right?
Oh, yeah, all the time.
And there's this. If you look at FinTwit or some of the influencers in this industry, the way they frame everything is that they're always buying the bottom and they're always selling the top and they're perfect. And there's a certain segment of the population that really gravitates towards that, right? You get these big services because they sell this dream. That's not the reality. The reality is it's tough, right? Trading is tough. And so when you know that other people are having the same struggles that you are, and you can communicate like I did this. Oh, well, this helped me do that, and you go, oh, it's just a great feeling, and it helps you.
Yeah, that actually is a little bit of a pet peeve, which I've gotten over. Is that people there's like, I don't know, this OG FinTwit community, StockTwits, and so forth. And if you have X amount of followers, and I think I have a tie in my profile picture, whatever, or you've done some TV, people put you in a pedestal or category when they don't realize we're all just human.
Right.
So when I get a resume and someone's like, can I work in your mailroom? And I'm like, mailroom? Like, what are you talking about? I'm not at 100 Park Ave with floor-to-ceiling windows on the 70th floor. Like, my point is, like, to your point, like, we're all, like, not just struggling, we're all in this together. And I think they assume, I'll give you two quick examples. One of them was someone said to me, I mentioned someone's name, and they're like, oh, that guy's a great trader. And I'm like, that person doesn't even have an E-Trade account. Like, what are you talking about? Or even Robin or nothing. And like, under my breath, I'm just like, what do you, oh, they're a great trader because they have this many followers on Twitter. And I'm like, that's what I mean by, then there's the opposite where there's people who are quiet managing, billions of dollars. So
yeah,
it's interesting. My point of all this, it was a pet peeve because I think so many people are trying to compare and trying to do this and trying to say, oh, you have this many followers, and like, just worry about yourself is really what it comes down to.
Yeah, and a lot of people are in the business of trading, not really trading, or the business of investing, right? They want to represent that lifestyle and what they're doing, but they're not really teaching. They don't have any skills. Like, I'm not a teacher, but like, I show people what I do, and they can go, oh, that works for me. It doesn't work for me. I think a lot of these services are just like, what's the quickest way to get a Lambo, and how am I going to retire? And again, when I got on Substack, Substack's been very kind to me. And at one point they said, we're going to hook you up with an ad agency. We're going to pay their fee for like 3 months, and we're going to have them help you get your subscribers, count to a different level. And these guys were really nice. I had nothing against them, but they wanted me to do like all these slick, do you want to do this in your life? And and put these ads on Facebook. And it just felt so wrong.
Dirty.
And not only did it feel wrong and dirty, but you attract the wrong people, right? You attract people that want easy money, right? That want a quick fix, that want easy answers. Just tell me what to buy. And that's not sustainable. Right, because I trade different than this person. We may trade the same stock, but we may have different risk profiles, different time frames. So I always look at the Lund Loop as like, I'm going to do a lot of the legwork for you and narrow it down to some of the things I think are the best and why I think they are the best. I'm doing that work anyway, right? But I can't sit there and take your hand and tell you what to buy and what not to buy. I'm not going to send you text messages to say, here's an alert.
All right, but that's what people want. That's what the majority of people want.
Of course they do. Of course.
They want, make me a bicycle clown.
Yeah.
Tell me where to buy, tell me where to sell, tell me where to stop myself out.
Right.
When, to your point, I don't think people realize there are a million variables. So you can't tell Warren Buffett, buy at 50 and stop yourself out at 48. Like, that's not going to happen. He might be buying it down to 20.
Right.
You also can't tell a day trader, buy at 50 and stop at 45, because that's too big of a stop if it even hits that during the day.
Yeah.
Because it might not have that range. So, but you can guide them to it. And again, shout out to Brian Shannon with his expression, make the ideas your own.
Right.
Like, you figure it out. Are you trading full time? Are you working full time and you like to peek in on the markets? Your age, your risk tolerance. Do you have a wedding to pay for? Do you have a house to pay for? There's so many variables here.
Yep.
But people are like, no, make me a bicycle. Tell me. And they don't realize, like, there isn't one size fits all for everybody.
And people want easy answers. They just want easy answers. And one of the things they look for in the markets is like the holy grail. And Brian and I were talking about this today on the way back from the mountains where I almost died. Just so you know, Brian is like, he lives.
He's in insane shape.
Not in insane shape, but he lives in Colorado. So he's skiing and he's up at elevation.
Right.
I'm like, I'm going to go out there and I'm going to, and he's like a Sherpa. And I'm like, right. Anyway, so we're talking about.
You can't even reach the 911 on your phone. You're like, I must keep going.
Energy bar. So we were talking about the idea of short interest, right?
Yeah.
As a certain variable. And we were talking that there's so many ways you can interpret short interest. People will take one concept like short interest and they'll say, this is the thing that's going to tell me whether I should buy or I shouldn't buy, right?
Yeah.
Or, this crosses the 200-day moving average or it's seasonality. What they don't understand is these are just pieces of the puzzle. You have to take all these things and put them together. Not one of these things is going to be the silver bullet that's going to make you money all the time. And people don't like that answer, right? Because it's tough, right? Again, I always say, trading isn't easy, but it doesn't have to be complicated. I figure the fewer studies I have, the less noise that I allow into my process, the easier it is for me to find signal. But it wasn't always that way. I was, trying to put every single indicator I could find. And, it's frustrating because when you've done it this long and you've seen all the mistakes and you've made all the mistakes yourself, you want to tell people, hey, you don't have to make all those mistakes. Trust me, right? But it's like having kids. On some level, they have to make those mistakes themselves to really understand them. You can't do it for them. And you just hope that they don't make a mistake that is so critical that it takes them out of the game.
Yeah. I think it's important to encourage people to think on their own, even though, like you said, they want it simple. Just tell me the answers. I don't care what the company does. Just tell me what to do.
Right.
But then what happens when, the Lund Loop goes away and you decide, okay, I'm done with this. And, and you're choosing between those three, Lambos that you're looking at, and you're retired and then what? Then they're like, okay, the guy or the gal who's spoon feeding me the ideas is gone. And then what?
Yeah.
But if you teach them how to fish, so to speak, or give them, sort of, I can lead you to this and make it your own and think on your own, that gives them something they can take away for life.
And the reason that those cliches are so well known is because they're so true. It's right. If you give a man a fish, he eats for a day. If you teach him how to fish, he eats for a lifetime. And that's the same thing in the markets.
Yeah, no, that's true. Any sort of concepts when you first started, you thought about the stock market that were dead wrong, or things now maybe new people think about the markets? I know it's kind of a wide open question.
Yeah,
but.
No. I mean, when I first started, I had this philosophy like, it'll always come back, right?
Everything comes back.
Right? And we all know how it goes. You start with a trade and you go, I'm going to trade this for 3 to 5 days and I'm going to get out here. And then it goes south and it becomes an investment, right? And you go, well, I'll average down. And I would think like, well, eventually it's going to come back. And sometimes they do come back. Well, a lot of times they never come back, right? for example, the pot stocks in the last 4 years, right?
Yeah.
And so I wish
10 years.
Yeah. So I wish I understood that a little bit better. When I was starting out, for sure I would have saved myself a lot of money.
Yeah. Anything now, though, do you think people think about the markets that they come up to you and you're like, look, I'm sorry, that's just dead wrong?
Yeah. So this goes to your famous saying about how when people ask you to party, what you do, you say you work in an ice cream shop. Because you just don't want to get into that.
You've been using that, I can tell.
Yeah. I think it's a great line. I think what people don't understand is that this is my philosophy. I might be right, I might be wrong. I think making money in the markets has less to do with how good of a stock picker you are and how good of your analysis is, and has more to do with issues from your family of origin, your mom didn't love you, or you weren't picked for the soccer team when you were in high school. And what happens is when things happen to us as kids, we create these adaptions. We don't even know that we're doing it, but we do it because we have to survive. We have to get through situations. But oftentimes when those factors that create the adaptions go away, they become maladaptions. So I'll give you an example. So like I'll give you a non-market example. So let's say you have a emotionally abusive mother, right? Well, if you're a kid, you're going to keep all your feelings in because you're not going to want to give her more fodder to like jump on you, right? So you do that, then you grow up, you're 35 years old, you have a kid, family, your mom's long dead, but you're having problems with your wife. Why? Because you won't communicate with her, because you still have that adaption that's turned into a maladaption. Right?
Okay.
One of the ways it works in the market, and there's so many of these, but like you watch your dad go to the appliance store or to buy a car, and what is he going to do? He's going to beat up the salesman. He wants to get the lowest price possible, right? The lower the better. So you see that as a kid, and you go, that's the way to do it. You come into the market as a 35-year-old, you buy a stock at 40, and it drops to 30, and you go, ooh, it's on sale. This is a deal, right? I'm going to buy more. Then it drops to 25, you buy more, right? You're bringing in a faulty analysis that works in a different part of life.
Right.
It doesn't work in the market. Here you've got a wasting asset, a car, a refrigerator. A stock is not a wasting asset, right? So I think there's a lot of those adaptions that become maladaptions in the market, and we're mostly not aware of them, or we're aware of them when it's too late. And this is why I tell everyone, this is the number one thing I tell traders, investors that are struggling or that want to get to market. Go to therapy.
Go to therapy. I've heard you say that.
Go to therapy because you'll find out things about yourself, and you'll make connections that you would never have thought would have anything to do with the market. And it's like just letting go of weights. You go, oh, I don't have to hold these weights, right? I'm not going to say that it guarantees that you'll be successful, but it evens the playing field, right? That you at least have a chance to then become successful.
So you're saying a lot of this, so it's stuff from our youth or something that happened, society, an ex, whatever, boyfriend, girlfriend, parent, whatever, a drunk uncle at Thanksgiving, something happens, and subconsciously that trauma or that effect could have carry over subconsciously into your trading.
Right. So like for me personally, like when I was a kid, I wanted to be right about everything, right? I wanted to show how smart I was, and I don't know, it may have been some dynamic between me and my parents, whatever. So you come into the market, and what is trading mostly about? Being wrong, right?
Yeah.
It's mostly about saying, I'm going to go with this stock. No, I'm wrong. This stock, wrong. No, oh, this one I'm right. You're going to be wrong way more than you're going to be right. It's hard to sell that stock if you always want to be right. So I'm bringing in this attitude that I had as a cocky young kid about I know everything, I'm going to be right. And that translates to I'm not going to sell this stock, because selling it is admitting that I'm wrong. Now, I'm not thinking this consciously, but subconsciously it's in there, right?
Yeah. No, it's a great point. A few more topics I want to get into really quick. You're in a movie?
Yeah, Burt Convey, Diane Cannon.
Yeah.
It's going to be good.
Tell us a little bit about that.
It just reminded me, because we talked about questions that we might, back and forth. It reminds me of like the old school, Carson, right?
Yeah.
It seems so spontaneous, right? But like, hey, aren't you in that new movie with Diane Cannon? So,
tell us a little bit about that.
Well, so it's a thriller, and it takes place in a lighthouse in the East Coast. And I'm not in the movie.
Right, that's funny. No, one of the things I read, one of the first pieces I loved, and I tweet it out every once in a while, is the concept of R. risk reward and so forth. Can you explain, like, because you did a great job, and I could probably tweet it out again after we post this. Explain the concept of R.
So first of all, it's not my concept. I think it's from Van Tharp.
Yeah.
How the name of the book is so cheesy. I think it's How to Make Money for a Living in Trading, something like that. But the book's really
He's
good.
a couple of books, yeah.
Yeah, and unfortunately he's passed away. But R is both risk and reward. So the idea is people, the way they size their positions mostly is they go, 500 shares, 1,000 shares, whatever. The idea is you reverse engineer your position size based upon the difference between what price you get in and what price you think you would reasonably be wrong, right? So let's say you get in at 50, you think I'll be wrong at 49, you're risking $1, right? Then the opposite of that is you have a reasonable target that you think you could get to, right? So based upon chart analysis, right? So we're not just pulling out of the air. So I'm going to get in at 50, I'll be wrong at 49. I think there's a reasonable chance to get to 53. In that scenario, you're risking $1, right, to get 3. So the R risk is 1, the reward is 3. So that's a 1 to 3 ratio. So if you have your R ratio 1 to 3 or higher, you can lose on more trades and still be profitable, right? If you're trying to get a 1-to-1 return, like we talked about earlier, you're going to lose on more trades than you're going to win. And if you're getting a 1-to-1 return, you're always going to be losing money.
Yeah, a lot of people forget that if you buy at 50, you can't stop at 49 and take 51. You can't lose $1, make $1, lose $1, make $1, because I know there's people like, oh, my batting average is 92% or 70%. Come on, the best in the business are 50. The absolute best.
The
in the
best.
Business. Like the billionaire best.
It's more like 30.
Yeah, exactly. So Paul Tudor Jones even tries to shoot for 5-to-1, 5R.
Right.
So he's like, all right, I'll risk $1 to make 5 on a lot of his trades.
Right.
So,
and look, this is an oversimplified example. I mean, you're going to have slippage. You're going to have, commissions not so much anymore. But the point is, when you're thinking about your trade, like let's say you're laddering into a trade, you just have to have that mentality, right? Do I have more of a chance of upside? Are my odds better for the upside than they are for the downside? Doesn't mean that the upside is going to work out, but it means if you do that consistently over time, again, you can lose on a lot of your trades and still end up being profitable. O'Neill talks about this, right?
Yeah.
I mean, where if you have, I can't remember if it's 3 or 4 trades, but if you split your trades up and you take quick losses on 3 of them and let your
it's 3 trades. If you lose 7% on 2 and
Right.
make 20 on the other, that's about a 3R.
Right.
So you're right on 1 out of 3 trades, you still net a profit.
Right.
So it's the same concept, and I know a lot of great traders and investors have talked about this, but I think so many people forget. They're like, oh, I'm going to make $1. Well, what was your risk? I don't know. I didn't really have a plan. Well, have a plan, know what your risk is, but make sure, I say at least try to keep it a 2-to-1 if you can.
Right.
For beginner traders. So lose $1, try to shoot for 2.
Yeah.
If you can achieve 3, forget it. Like that's and even if you're right 30% of the time,
Right.
you're going to make money.
Yeah. I mean, it's somewhat related to the venture capital model too, where you're going to do like 10 different investments and most of them are not going to work out, but 1 or 2 are really going to
A home run, yeah.
So it's just quantifying risk. It's at least thinking about risk instead of just going, I'm going to buy X amount of shares and whatever happens.
Yeah. And I mean, I could talk to you for days, so we could talk for hours about this stuff,
Sure.
but in the few minutes we have left, what's the 1, 2, 3 top advice you give yourself or to younger traders, or you give yourself, 20, 30 years ago?
Yeah, well, it's always going to be therapy. Therapy is the number one thing.
Okay.
Right? Because you need an independent third party that's not your buddy, that's not your wife, right, or your husband, to call you out on your bullshit. And by the way, this is an important point. You need to go to old school therapy, right? New school therapy is come to my office or get on a Zoom, bitch for an hour. I'll send you a $250 bill, and we'll do this for 20 years. Okay.
Yeah.
And nothing gets solved.
No solution ever.
No, you need to go into therapy and you need to make sure your therapist knows, like, look, I want to identify some stuff. And when I identify, I want to work on it. Like, there are cognitive exercises and things that you can do to help minimize and sometimes eliminate these issues that are holding you back. So you got to go to old school therapy. I would think the second thing is don't be in such a rush. I think that's another thing I would have told my younger self is, everyone wants to make $1 gazillion yesterday. we see it all the time. Everyone's chasing the hot stock, the fast stock. I would say just slow down a little bit. And I think the third one, and this is a little bit underrated, and it skews a little bit older because it's not such a factor for young people, is you have to take care of your physical and emotional health. This is something that our friend Phil Perlman talks about a lot, right? And he's really good on this because it's one of those things where there's a book, Atomic Habits, and it's the book everyone has read or claim they've read.
Yeah.
And it's got some good stuff in it. Some stuff's okay. But one of the key concepts is this thing called upstream habits. And if you can get a upstream habit in place, it makes beneficial downstream habits easier to do. I think one of the core concepts, the core upstream habits is health, right? Now we talked about therapy, but like emotional and physical health, because it will seep into your trading and in your investing, into your mindset in ways that you won't even know, right? And so you'll be like, why am I doing this? Why am I doing that? It may be just because emotionally you shouldn't have been trading that day, or maybe it's something like this where you think that you should be a trader. Like I'm in there and I'm going to be like, here's the old guy reference, Gordon Gekko, right? But maybe emotionally you're not set up to be a trader, right? Maybe you're emotionally set up to be an investor, right? So if you've got your emotions out of whack and you're not in tune with yourself, it can just cause a lot of trouble.
Yeah. It's a lot to absorb. I mean, it's a lot of great concepts and a lot of insight. We're doing a part 2 on music. Hopefully we'll do another part 3, 4, 5, up to part 10. And I mean, I'd love to have you back on. And I always enjoy our conversation, so I want this to continue with some future episodes. But I want to thank you for your inspiration. Thank you for being a great friend. Thanks for being here. Any closing thoughts besides just go to therapy?
No, yeah. Everybody go to therapy. Look at camera and go to therapy. No, thanks for having me. I appreciate it. I love this.
Yeah, thanks. We'll definitely do it again soon. Thank you.